Hi everyone and welcome back to the channel. With used car prices going to a record high in 2021 and holding throughout much of 2022, we are finally starting to see relief here in the latter parts of 2022 and getting into 2023. So what does this mean for you? Is it time to buy a newer used car? Is it time to sell your car? And finally, what does this mean for the dealers? All of this data can help you make the right financial decision. So let's get into it. In the last CPI report, we learned that used car prices had gone down 8.8% from November to December. After years of increased prices, what has caused the market to finally go downward? Well, one main consideration is interest rates. Interest rates have been very high and it's causing people to max out on their payments. And what do I mean by this? Well, a lot of people had really low interest rates on their previous auto loan, and now their interest rates are a lot higher. It's making their payments so high they cannot afford to buy a new car. Leave a comment below if you think these high interest rates are affecting more than just the used car industry. According to Bankrate.com, a new car loan is at 6.17% for 60 months, and that's for well-qualified buyers. On the other hand, if you're looking to take a shorter term loan, you're not going to get much relief there either, as the rate is at 6.16% for a 48-month loan. Ultimately, this does make a big deal, but we need to understand how this affects each person buying a car. As interest rates continue to rise, it makes less and less people able to afford a new car. And that tightens the market and makes it harder for people to buy a new car because they simply cannot afford the new payment. Not only does this hurt consumers, it also hurts the dealerships. Just like customers, dealerships are struggling with the higher interest rates too, and it might not be the way you think. Something that you might not know is a lot of dealerships do not own all of the cars that sit on their lot. A lot of them have a line of credit or a loan that allows them to pay interest-only payments on all of the principal that's sitting on their lot. So every car is not truly owned by them. It's just a loan and they're making interest-only payments on them. With record low interest rates, this allowed dealerships to not feel as pressured to sell a car because they could afford to make that interest-only payment for a lot longer. Now that interest rates are higher, it's making it more expensive for them to keep cars on their lot, and they're feeling a lot more pressure to get that car sold even if it's for a lower price. As interest rates rise and dealership line of credits start to increase their interest payments, one of two things is going to happen. Number one, they'll start to sell cars quicker because they cannot afford to have these cars on their lot. The interest payment's going to be very high, and it's not going to make sense for them to keep this car in their lot, so they'll be willing to take less money for it. Or number two, they'll start buying less cars because they can't afford to have their lots as full. Unfortunately, with this scenario, things get a little grim. If we see that they're starting to have less cars on their lot, they're not going to have as many options to sell to people. Therefore, less customers are going to come in, they'll probably sell less cars, and in the end, they're going to be making less money. If they're making less money, they won't be able to make their payments, they won't be able to have new cars because they'll have less money coming in, and ultimately it's just a downhill spiral until the dealership goes bankrupt. And that, guys, is how dealerships do go bankrupt. They're not selling enough cars to bring in new money and keep a consistent cash flow, because you have to have cash flow when you have a car dealership. As interest rates start to affect you and the dealerships, there's a third piece of the puzzle you need to be thinking about, and that's inventory. OEMs are not going to stop producing new cars, so that means there's going to be a dramatic increase in new cars available for sale. That's going to hurt the dealerships, but it could be an opportunity for you. And you might be saying to yourself, why will this drastically happen now? And that's because all of these things are going to be happening at once. All three of these things. You're going to be hurt, the dealership's going to be hurt, and there's going to be a huge amount of inventory. And I think that's going to be the perfect storm to have a really bad year for cars in 2023. If you're thinking about buying a newer used car in 2023, I think you need to pump the brakes a little bit. Stop and think about the financial decision that you're making. But if you really need to, go ahead and think about these two decisions. Number one, you should try to buy with cash, as you won't be underwater on your loan and you won't be paying the high rate of interest that everyone else is. And number two, try to wait until mid to late 2023 to buy your car. I think that's when everything's going to come crashing down and you're going to get the most bang for your buck when buying a car. Obviously, if you get into a car accident or your car breaks down, that's a completely different circumstance. You should not be necessarily paying attention to those two things I said. You need to decide what's best for you and your family and your financial goals, so take those into consideration. We're here on the channel to help you though, so leave a comment if you have any questions and I'll try to help you out. One other small piece of information is as car prices continue to go down, do not expect to get very much money for that car you're trading in. Honestly, I just don't see prices being as high as they previously were, and dealerships don't want to take the risk of paying you a lot of money for your car and then not being able to get any money out of it. Honestly, you need to make sure you're not underwater on your current car, and if you are, you need to consider getting gap insurance. Don't get it through the dealership though, get it through your car insurance provider, as that's going to save you a lot of money. You don't want to be carrying any negative equity into a new car, and you absolutely don't want to be continuing to make a payment on a car you don't have anymore because you got into an accident. If you're in the market for a new car and you have a lot of money sitting around but you don't know what to do with it, check out this video right here to find out where you want to put it so you can get the best return on your investment. Also, make sure you like, subscribe, and comment on this video. Otherwise, I'll catch you guys in the next one.